Pension insolvency isn't an act of God. It's the inevitable crash of a machine built on false promises and risky bets. As 1.3 million face plan failures and PBGC runs dry by next year, ask, who profits from this betrayal? The pension crisis is not a demographic accident. It is the predictable outcome of a system designed to transfer risk from capital to labor, enriching asset managers while leaving workers to bear the losses. 40 million American retirees now stare down benefit cuts or outright insolvency across three interlocking systems: private multi-employer pensions, state and local public pensions, and Social Security itself. Each pillar is cracking under the weight of the same structural flaws: optimistic assumptions, reckless investment strategies, and governance structures that serve Wall Street before Main Street. This is not a story of mathematics gone wrong. It is a story of power, of who rules via which rules, and of a social contract shredded in the name of financialization. Start with the scale of the catastrophe. The Pension Benefit Guaranty Corporation's multi-employer insurance program covers over 10 million people: truck drivers, miners, construction workers, the backbone of American industry. This program faces a greater than 90% likelihood of insolvency by the end of fiscal year 2025. Not in a decade, not in 5 years, next year. When it goes under, roughly 130 multi-employer pension plans covering 1.3 million participants will run out of money over the next 20 years. The PBGC projects its own deficits will swell to nearly $90 billion by 2027. Meanwhile, the single employer program, covering 28 million workers in corporate plans, is actually improving. Same insurance agency, same country, radically different fates. The workers in declining industries, those who built the infrastructure, hold the goods, mine the coal, get the short end of the stick, while white-collar corporate employees enjoy relative security. This is not an accident of design. It is design itself. Now zoom out to state and local public pensions. These systems, covering teachers, firefighters, police officers, sanitation workers, report funded ratios of 78 to 81%. Sounds almost healthy, doesn't it? 78 cents saved for every dollar promised. But flip that ratio around. 22 cents missing per dollar owed. Across the entire landscape of state and local pensions, that missing 22 cents adds up to $1.48 trillion in unfunded liabilities at the end of 2024. That is down slightly from $1.62 trillion the year before, thanks to strong market returns and record contributions. But here is the rub. Stress tests show that a single economic downturn could double that hole to $2.74 trillion by 2026. The appearance of improvement is a mirage, sustained by a bull market and political willingness to shovel money into the furnace. The moment the market turns, the illusion evaporates. Then there is Social Security, the third pillar. The combined trust funds face insolvency in 2034. When that happens, the law mandates automatic benefit cuts of 23% across the board, or 19% if the old age and disability funds are combined. 23%. Imagine you're 70 years old, living on a fixed income, and one morning your check is nearly a quarter smaller. The actuarial imbalance over 75 years stands at 3.82% of payroll, and it is worsening every year Congress delays action. Fixing it would require either a 29% increase in payroll taxes or a 22% cut in benefits, and no single policy lever is sufficient on its own. Eliminate the wage cap on payroll taxes? Not enough. Price index benefits instead of wage index them? Still not enough. The scale of the shortfall demands a combination of painful measures, and the political will to enact them is nowhere in sight. Why is this happening? Let us talk about the demographic time bomb. Public pension systems saw their retiree and inactive member populations explode from 7.6 million in 2001 to 18.8 million in 2024. Over the same period, active employees, the workers paying into the system, rose only from 12.7 million to 14.5 million. Retirees now outnumber active workers in many systems, flipping cash flows from positive to negative. Benefits paid out exceed contributions coming in. That means pension funds must sell assets to cover the gap. In a bull market, that is manageable. In a downturn, it becomes a death spiral. Falling asset values force more selling, which drives prices down further, locking in losses and amplifying the crash. This demographic inversion is structural. It does not matter how well the stock market performs in any given year. The math is inexorable. But demographics alone do not explain the crisis. Enter the false promise, optimistic return assumptions. Pension boards across the country assume their investments will return roughly 7% per year, every year, forever. This assumption is not grounded in reality. It is grounded in political convenience. Why? Because the higher the assumed return, the lower the required contribution today. Politicians and employers love this. It lets them underfund pensions now and kick the bill down the road. But markets do not deliver 7% every year. They deliver wild volatility. In 2021, some funds saw returns of plus 25%. In 2022, minus 5%. In 2009, minus 12.9%. When actual returns fall short of the 7% target, the gap between assets and liabilities widens. The shortfall must be made up somehow, either through higher contributions from taxpayers and employers, or through benefit cuts for retirees. The 7% assumption is not a forecast. It is a fiction that allows the pain to be deferred and the blame to be diffused. This fiction has consequences. It drives what economists call the search for yield. To hit that 7% target, pension funds have shifted their portfolios into riskier and riskier assets: equities, private equity, hedge funds, derivatives, real estate, infrastructure, anything that promises higher returns. On average, pension funds increased their allocation to risky assets by more than 4 percentage points. The problem is that risk cuts both ways. In good times, these bets pay off and funded ratios improve. In bad times, losses are catastrophic. The International Monetary Fund has warned that this search for yield raises the risk of counterparty default, illiquidity, and market destabilization. When pension funds are forced to rebalance during a crash, selling assets to meet benefit payments, they engage in procyclical selling that amplifies the downturn. In 2022, pension funds globally saw returns between minus 18 and minus 21%, exacerbated by high inflation. The very strategies meant to close funding gaps can, in a crisis, blow those gaps wide open. So who profits from this arrangement? Follow the money. Asset managers and financial intermediaries collect fees on trillions of dollars in pension assets, regardless of performance. The larger the asset base, the more complex the investment strategy, the higher the fees. Pensions pay management fees on equities, alternatives, swaps, and structured products. When a pension fund loses money, the workers and taxpayers eat the loss. When a pension fund makes money, the asset managers take their cut off the top. Losses are socialized, fees are privatized. Consider the Netherlands, where pension funds used interest rate swaps to hedge against rate changes. The funds delayed indexation, meaning retirees did not get cost of living adjustments, while the managers who structured and traded those swaps earned their fees. The system is designed to enrich financial intermediaries while transferring risk onto the shoulders of workers and retirees. Now, you might hear defenders of the system point to recent reforms. The Multi-Employer Pension Reform Act of 2014, for instance, allows pension plans to cut benefits, so-called suspensions, in order to remain solvent longer. It also permits plan partitions, where the weakest plans are split off and their liabilities transferred to the PBGC. These measures were sold as necessary medicine, tough choices to keep plans alive. But look at the projections. Despite these reforms, the PBGC's multi-employer deficits are still projected to balloon to $89.5 billion by 2027. The reforms did not address the root causes: chronic underfunding, risky investment strategies, declining union membership in key industries. They simply shifted the pain onto participants, allowing cuts to benefits that workers had already earned, while the structural problems festered. Here is another contradiction. States and employers are now paying record contributions into public pension systems. 41 states met their net amortization benchmarks in 2023, collectively paying down $36.3 billion in pension debt. Contributions are near historic highs. And yet, analysts describe the situation as pension debt paralysis. High contributions are slowing the growth of the debt, but they are not closing the gap. Why? Because liabilities are growing even faster, driven by low returns, demographic shifts, and the compounding effect of past underfunding. Fiscal rules and contribution benchmarks prioritize stability, keeping the system from collapsing today, over solvency, actually fixing the problem for tomorrow. It is like bailing water out of a sinking boat without plugging the hole. Let us put this in historical context. The pension crisis echoes the savings and loan collapse of the 1980s. Back then, savings and loan institutions were deregulated and allowed to chase higher yields in riskier markets. They made bad bets, failed en masse, and required a taxpayer bailout of $125 billion. The pattern is identical: deregulation, a search for yield, privatized gains in the good times, socialized losses when the bets go bad. Pension funds have followed the same trajectory. Governance structures were loosened, investment restrictions were lifted, and funds piled into complex, opaque assets. When those bets pay off, asset managers collect fees and politicians claim credit. When they fail, workers lose their benefits and taxpayers foot the bill. The savings and loan crisis was a dress rehearsal. The pension crisis is the main event. Who makes these decisions? Pension boards, dominated by political appointees and industry insiders, set the return assumptions and investment strategies. These boards face a dual mandate that is inherently contradictory. On one hand, they are pressured to minimize contributions, which pleases politicians who do not want to raise taxes and employers who do not want to increase payroll costs. On the other hand, they are pressured to maximize the returns, which pleases Wall Street and justifies riskier investments. This dual mandate incentivizes optimistic assumptions and reckless bets. The boards lack accountability to the workers, whose retirements are at stake. Governance structures are designed to serve political and financial elites, not beneficiaries. When things go wrong, board members face no personal consequences. The workers do. We return to the unequal crisis within the PBGC itself. The single employer program is improving, while the multi-employer program faces certain insolvency. Why the divergence? Single employer plans are backed by stronger corporate sponsors and charge higher premiums. Multi-employer plans are tied to declining industries, trucking, mining, construction, where union membership has collapsed and employers have gone bankrupt. The insurance design bakes in structural inequality. Workers in dying industries who need the safety net most get the weakest protection. Workers in thriving sectors who need it least get the strongest. This is not a bug. It is a feature of a system that values capital over labor. Now, let us stillman the opposing view. Defenders of the current system will point to funded ratios rising from 78% to 81%, record contributions, and the fact that 30 of the 100 largest public pension plans are now funded above 90%. They will argue that stress tests represent worst-case scenarios, not certainties, and that strong returns in 2021 through 2024 have stabilized many plans. High contributions and prudent management, they say, are working. The crisis is overblown. Here is the rebuttal. The improvement is cosmetic, a product of a bull market and emergency injections of cash. Stress tests are not wild speculation. They model realistic downturns based on historical volatility. And those tests show that one recession could double unfunded liabilities to $2.74 trillion by 2026. The funded ratio is a snapshot, not a trajectory. It improves in bull markets and collapses in downturns. More fundamentally, the demographic inversion means that pension funds are now in negative cash flow. They must sell assets to pay benefits. In a downturn, that forced selling locks in losses and amplifies the crash. The global pension losses of 2022, minus 18 to minus 21% in some jurisdictions, demonstrate the fragility. Stability is temporary. The underlying structure is unsound. What does this mean in practice? Insolvency will force a brutal choice. Either slash benefits for 40 million retirees or impose massive tax hikes and austerity on workers and public services. When the PBGC's multi-employer program goes insolvent, benefits will be cut to pennies on the dollar. Some retirees could see their checks reduced by 70 or 80%. When Social Security's trust funds run dry in 2034, automatic cuts of 23% kick in unless Congress acts. And Congress has shown no appetite for the necessary tax increases. Public pension shortfalls will require either higher state and local taxes, hitting working families, or cuts to schools, healthcare, infrastructure, the services that working families depend on. The crisis will be resolved on the backs of the many, while the few who profited from financialization walk away unscathed. What should you watch in the next 3 years? The window from 2025 to 2027 is decisive. The PBGC's multi-employer program faces over 90% probability of insolvency by the end of fiscal year 2025. That is months away, not years. Social Security trustees will release annual reports showing whether the 2034 cliff is accelerating or holding steady. State pension returns in the wake of tariff-driven market volatility in 2025 will reveal whether funded ratios hold or collapse. If markets stumble or recession hits, funded ratios will plunge and political pressure for bailouts or cuts will explode. Watch for emergency legislation, benefit suspension announcements, and state fiscal crisis. The fuse is lit. What must be demanded politically? First, accountability. Pension boards must be accountable to workers, not Wall Street. Governance should shift to worker-elected trustees who have skin in the game. Second, ban the riskiest bets. Cap allocations to alternatives, derivatives, and illiquid assets. Require transparency in fees and performance. Third, fund the shortfalls justly. Do not cut benefits for workers who paid in and played by the rules. Finance the gaps through wealth taxes on those who profited from financialization. Taxes on financial transactions, on top incomes, on the capital gains that ballooned during the same decades pensions were hollowed out. The money exists. It has simply been funneled upward. Pensions were a promise. Work hard, contribute your share, and retire with dignity. Financialization turned that promise into a casino chip, a speculative instrument traded and leveraged for the benefit of asset managers and political elites. 40 million retirees are now collateral damage in a game they never agreed to play. The machine was built this way. The insolvency was designed in. When the bill comes due, will we let the many pay for the few's gamble? Or will we finally make the profiteers answer for this betrayal?